John, welcome back to Rapallo, mate. What's it like second time around for you?
Well, fabulous to be here at Rapallo. I feel like a character out of the talented Mr. Ripley, Simon. It's fantastic. Clearly the centre of European mining.
Right, exactly. You know, there was some other famous people, not quite as famous as you, that have stayed here before you. So there's a bit of history with performers equally as talented
Lovely
as you.
part of the world. Great to be back.
John, let's talk about Fenix. I love the shirt. In uniform today, as we look over the Cinque Terre. You've been their chairman for 2 years now.
Yes.
I noticed that there's been a frenzy of deal making this year, and you're going from one mine today to 3 mines next year. Can we think about your first mine, Iron Ridge, and talk to us about what capital went in and what you've taken out for shareholders as a case study for the next?
Yeah, look, thanks for noticing. I think it's been a disciplined and calm expansion, but we are really excited at Fenix about our growth agenda. And it does start with the success of Iron Ridge. So let me tell you about that mine. The company started, as a lot of ASX junior resource companies do, based on the potential of the Iron Ridge deposit, drilled out long ago. It's the highest grade iron ore deposit on mainland Australia. We have 65% iron ore, quite small, 10 million tonnes. We raised $15 million from the market in August of 2020, and that was to fund a $15 million feasibility study of starting a 1.3 million tonne per annum mine, 500 kilometres of road haulage, the port of Geraldton. And that development plan and execution was absolutely perfectly executed, which is what attracted me to Fenix. And you're right, I've been there 2 years and I've really doubled down on what's a very exciting company. The $15 million we raised in 2020, we've since paid back $65 million in fully franked dividends. We've invested more than $100 million into the business, and we finished the 2024 financial year in Australia to 30 June with almost $80 million in cash. So the Iron Ridge mine has generated more than $200 million of value for Fenix shareholders.
Wow. And
you're correct that we, during that period of time, the deals you mentioned, really the 3 key ones are we've consolidated what was originally a haulage joint venture. And so we now own 100% of the Newhaul business, founded by Craig Mitchell, and Craig Mitchell is a fellow executive director of Fenix. And a very important part of our business. We acquired the Midwest assets of Mount Gibson Mining, the most successful miner in the Midwest. They've mined 50 million tonnes, developed significant infrastructure at the port of Geraldton, as well as rail sidings to the south and to the north of the Midwest, and also spent $40 million developing the Shine iron ore mine, which was on care and maintenance. And then the third transaction is we acquired the right to mine 10 million tonnes from the Beebyn W11 deposit, which is 20 kilometres from Iron Ridge.
Right.
So you put all that together, and you're right, we're going from 1 mine to 3 because we're in the process of recommissioning the Shine iron ore mine, and we're in the process of commencing the mine at Beebyn W11. So by January 2025, we'll be mining 1.3 million tonnes consistently from Iron Ridge, 1.2 million tonnes per annum from Shine, and 1.5 million tonnes per annum from Beebyn. And that is a significant expansion of production, albeit in what is currently a bearish iron ore market. But to summarise Fenix, we've spoken about it as a mining company, and as you know, it's actually a mining company, a logistics company, and a port company. We have 3 pillars to our business. And the expansion of 1 mine to 3 is just the start of unlocking the trapped value of the Midwest in its resources projects.
Well, I think I'm right in saying I read recently that BHP has paid $100 billion of taxes and royalties to the state of West Australia from its iron ore business, which is its single most important business. So I think it'd be fair to say that Australia rides not on the sheep's back, but on iron ore's back.
Well, certainly in recent times, and certainly in Western Australia. Obviously, there's a lot of interest in the strategic metals. I think in many lists, iron ore is actually included. It's one of the most strategic metals because it underpins the production of steel, and therefore really is a proxy for global economic growth. BHP is a good example, but the largest companies in Australia, certainly the largest mining companies, and the richest individuals in Australia,
right,
have been driven on the back of the iron ore market. And I expect that to continue. Obviously, we've enjoyed some spectacular iron ore prices over the 3 years that Fenix has been in production, but we're preparing for lower iron ore prices. We use our hedging model. We've been very successful in bringing down our costs during a period of time where we've had stable and very relatively low production for a bulk commodity miner. So all of our strategy is around moving to a lower cost, higher volume market, as well as looking around to use particularly our port business and our logistics, haulage and rail operations for other commodities in the Midwest.
And John, I think I'm right in saying that because you're a junior company but with the capability of a major, you own all of your own infrastructure, which is unusual. Normally junior companies end up paying an economic rent to the owners of ports and rails and trucks, but you own all of that yourself. Is that why your costs have fallen in recent years from about $100 a tonne to get the iron ore on a boat in Geraldton to about 70 or 80?
Yes and no. Clearly the consolidation of our haulage operations was a big step change in cost. Also, we've been refining our model since inception and really looking at the efficiencies across the value chain. And that is the value chain across the entire business. So you're correct that we obviously own the Iron Ridge mine and operate that. We use a mining contractor, but we own and operate our logistics businesses, which are most of our cost structure. When we commissioned the mine, we were slightly above the feasibility cost, and we're now 4 years later in a market where there's been double-digit inflation below the feasibility that was completed in 2019. And we've really looked at reducing the costs across every part, but absolutely owning the key parts of our business is fundamental to be able to pull those levers.
Right.
I do make the point that we've been able to bring those costs down very impressively, unusually for bulk commodity miners, during a period where we haven't changed the denominator, as in the production volume, very much. So we do see further opportunities as we bulk up and as we mine more.
And if you look into the future, are there any big potential step changes where you can drive your costs lower as your tonnage increases?
You spoke that we're going from 1 mine to 3, so these are relatively small, relatively low strip ratio quarries, really,
right.
that we're opening up compared to the big iron ore miners in the Pilbara. There is a step change. We think we've got the capacity to do more than 10 million tonnes a year through the port.
Right.
And the inland port, for example, that we've invested in at Riverdini is really around looking at a far more efficient transport mechanism from the future resources that we see that Fenix might be able to monetize in the region. We drive, currently our quad road trains operate on public roads. So the entire consist of a prime mover and 4 loaded trailers is about 200 tonnes, and we get just under 150 tonne payloads. The opportunity to transition to a private haul road and run 400 tonne trucks, the opportunity that we're investigating about hybrid power prime movers, potentially hydrogen powered prime movers, would see us perhaps reduce our haulage costs by more than 100% again. Wow. From a step change down. So you mentioned that our break-even cost currently is around a $70 iron ore price. So at the current prices in the 90s, we're making a good margin, but iron ore prices might come lower. They also might bounce, as we've seen the last time they were at these sort of levels in November of 2022. But we're prepared for that. I think the step change from 1.5 million tonnes a year to 4 will allow us to target a break even at around $60, and right. We see in the next couple of years that continuing to be a profitable business for us in iron ore. Longer term, getting up above 10 million tonnes a year in our business, we think that our target will be to at or below $40.
Wow.
And then we start being alongside, as you say, the companies like BHP and Fortescue and the individuals like Gina and Andrew who have made enormous margins out of iron ore over a long period of time. And that is our ambition.
Impressive. John, I think last year you were voted the best presentation here at the Arlington Rapallo, so we're looking forward to hearing you.
Well, I thank you for that, Simon. I think, though, that when you told me that, you said I was the best presentation, but perhaps not the best project. And I mentioned to you that I think the performance of since then shows that we were among the better companies and the better performing companies since then. So I'll try and deliver as exciting a presentation as last year, but the most important thing is what I'll also try and deliver is ongoing positive performance against the peer group.
Well, if you can triple your production into next year, then I'm sure when you come back next year for the Arlington Rapallo that the share price will be a lot higher than it is today.
Well, it's great to be here, Simon. What a fabulous spot.
Thank you.